In this video, we'll explore the key ideas from Chapter 8. And get ready, because we're diving deep into modern portfolio theory, or MPT. This isn't just some dusty academic concept. It's a truly revolutionary way of thinking about investing. It actually offers the potential to achieve higher returns while, believe it or not, reducing your investment risk. It's kind of about uncovering some fundamental truths about how the financial markets really work, you know, shifting our understanding of what's genuinely possible.
Yeah, absolutely. For far too long, I think many investors, and maybe even some seasoned professionals, thought that outperforming the market was either just sheer luck, or maybe it was tied to some sort of superior, almost prophetic foresight. But this deep dive will hopefully reveal how academic insights, particularly from modern portfolio theory, have fundamentally reshaped that understanding. We've moved well beyond just traditional market forecasting here. It's about approaching investment strategy from a completely different, much more deliberate angle.
Okay, so let's start with the core concept then. We hear risk thrown around constantly in investing. But for MTT, we probably need a precise, actionable definition. I mean, beyond just the simple idea of losing money, how does modern finance truly define investment risk? Because risk often sounds pretty abstract until your portfolio is actually losing money.
That's a crucial point, yeah. While common sense definitely points to the possibility of suffering harm or loss, in investing, it specifically means the possibility that the return you expect from a security just won't materialize,
Yeah.
and especially the possibility that its price will fall. Think about, say, a short-term treasury bill. The risk of not getting your expected return, it's almost non-existent. You're practically guaranteed that return.
Right. Pretty safe.
But then you take a common stock, maybe from a local utility company, well, there's a much greater chance the dividend could be cut, or even more significantly, the stock price could drop. And that leads to a net loss for you, the investor.
Okay. So if that's the definition of risk, the chance you won't get the return you expect, how do we get our hands around it? Is it something we can actually quantify, or is it more of a gut feeling? Because often risk feels very, abstract.
Oh, it's absolutely quantifiable. The measurement naturally becomes about the dispersion of future returns, how spread out they might be. We typically use variance or standard deviation to quantify this. It sounds technical, but the idea is straightforward. Imagine an investor with a stock. They're expecting certain returns under different economic conditions. Let's say maybe one-third of the time the economy is normal, one-third experiences high growth, and for the remaining third, it faces stagflation. Under these different scenarios, the investor's expected return might average out to, say, 10% annually.
Right, the average. But here's where it gets really interesting, I think. Even with that 10% expected return, the actual annual return could swing wildly. Maybe a 30% gain in a good year, but a 10% loss in a bad one?
Yeah.
How do variance and standard deviation capture that kind of potential swing in a way that's actually useful for investors?
Variance measures precisely that spread how much the returns deviate or spread out from the average. So in that example where returns could be plus 30%, plus 10%, or negative 10%, the variance calculation gives you 0.0267. And the standard deviation, which is simply the square root of the variance, makes it a bit more intuitive. It would be sort of 0.1634 in this case. Think of standard deviation as the wobble factor.
Wobble factor, I like that.
Yeah. That 0.1634 tells us that on average, your returns could wobble by about 16.34% around that 10% expected return. The bigger the wobble, the bigger the risk of hitting those extreme highs or lows. Now, for portfolios with reasonably symmetrical return patterns like a well-diversified stock portfolio, dispersion effectively signals risk, because a larger standard deviation directly means a greater chance of a significant loss.
And there's a really helpful rule of thumb for understanding these symmetrical distributions, isn't there? Like, if you had a portfolio mirroring the S&P 500 and its average monthly return was around 1% and its standard deviation was, say, 4.5%, what does that actually tell us about what you might expect month to month?
It tells us quite a bit, actually. It means that roughly two-thirds of the monthly returns typically fell between negative 3.5% and plus 5.5%. That's one standard deviation below to one standard deviation above that 1% average. And about 95% of the time, the returns were between negative 8% and plus 10%. Two standard deviations either side. This really illustrates why standard deviation is such a commonly used proxy for volatility and, by extension, for risk. The wider that potential spread, the higher the risk of encountering those really disappointing outcomes that, investors naturally want to avoid.
It makes sense. It's the old saying, right? No risk, no reward. Sounds simple enough. But what does nearly a century of hard data actually show about that relationship? That link between taking on more risk and the returns you receive? And why must higher risk generally lead to higher expected returns? Is it just a reward for being brave, or is there a deeper market mechanism at play?
Well, it's fundamental market economics, really. Think about it. If a safe asset offered the exact same return as a risky one, why would anyone bother taking the risk?
Nobody would.
Exactly. So markets demand a premium, that extra bit of return to compensate investors for taking on that uncertainty. And historically, one of the most consistent and well-documented findings in finance is that over the long haul, investors have indeed received higher returns for taking on greater risk. Extensive studies, one covering nearly a century, from 1926 to 2013, clearly illustrate this. Common stocks have generally provided quite generous total returns. They've significantly outperformed long-term bonds, short-term treasury bills, and importantly, they've greatly outpaced the inflation rate over time.
So stocks are definitely better at preserving your purchasing power against inflation long term. But what's the real cost? What's the trade-off for those higher returns?
The cost, as we hinted, is their volatility. Stock returns can swing wildly. You see years with over 50% gains, like way back in 1933, and then years with nearly identical losses, like 1931. And even smaller company stocks show this pattern. They tend to deliver even higher average returns historically, but with even greater swings in their performance. Bigger wobbles. It's a clear, undeniable pattern. Higher returns consistently walk hand in hand with higher risk, measured by that greater dispersion of returns.
It's certainly not always an upward march either, is it? I definitely recall some pretty tough stretches for stock investors where patience was truly tested.
Oh, indeed. There have been multiple periods, sometimes 5 years or even longer, where common stocks actually delivered negative returns overall.
Yeah.
Think the early 1930s, the Great Depression era, or the early 1970s stagflation period, or even the early 2000s. It was often dubbed the lost decade for U.S. stocks. And of course, the sharp, sudden drops, like Black Monday in October 1987, those are etched in investor memory. Nevertheless, historically, patient investors who were willing to take on that risk have, eventually, been rewarded. But here's the key insight we're building towards. There are powerful ways for you, the investor, to proactively reduce this inherent risk. And this brings us right to that revolutionary idea, modern portfolio theory, which has truly transformed how professionals approach investing.
Okay, so let's connect the dots. What does this all mean for you, the individual wanting to invest? Can we somehow get those potentially higher returns that stocks offer, but maybe without quite so much of that stomach-churning volatility? This is precisely where modern portfolio theory, MPT, steps in, right? It promises a way to optimize that balance.
Exactly. MPT starts with a basic premise. Investors are generally risk-averse. We want high returns, sure, but we also crave a certain degree of certainty in our investment outcomes. We don't like nasty surprises. The genius of MPT is that it shows you, actually with rigorous mathematical proof, how to combine different investments within a portfolio in such a way that you minimize the overall portfolio risk for any desired level of return. It essentially provides a robust academic foundation for that age-old investing advice. Diversification is absolutely key to reducing risk.
And the person behind this breakthrough was Harry Markowitz. He eventually won a Nobel Prize for it back in 1990. His core idea, though, it almost sounds too good to be true, doesn't it? You can combine individually risky investments in such a way that the overall portfolio becomes less risky than any single one of its components. How does that seemingly contradictory idea actually work in practice?
Yeah, it does sound a bit like magic at first. And while the mathematics behind it can appear intimidating, the core concept is surprisingly simple to grasp. Let's imagine we live on a small island economy, and there are just two main businesses there. One runs a large tourist resort, beaches, golf courses, that sort of thing, and the other business is an umbrella manufacturer. Now, the weather profoundly affects both businesses, but in opposite ways. In sunny seasons, the resort thrives, business is booming. But the umbrella manufacturer's sales, they plummet. Nobody needs umbrellas.
Right.
Conversely, in rainy seasons, the resort's business is dismal. Nobody wants to be on the beach. But umbrella sales absolutely soar. So both businesses are individually quite risky, with wild swings in their annual returns, depending purely on the weather.
Okay, so if you just invested all your money in one of them, say the resort, you'd be completely at the mercy of the weather, right? Your returns would be all over the place year to year. But what happens if you take a diversified approach? If you put half your money in the resort and the other half in the umbrella company?
That's where the magic happens, as you say. During a sunny season, your investment in the resort generates a substantial profit. Great. At the same time, though, your investment in the umbrella manufacturer takes a loss. But, and here's the crucial part, the profit from the resort perfectly offsets the loss from the umbrella company. You end up with a nice, consistent 12.5% return on your total investment, regardless of whether it was sunny.
Regardless of the weather.
Regardless of the weather, the exact same thing happens in a rainy season, just the other way around. The umbrella company profits big, offsetting the resort's losses. You still get 12.5%. The key to this amazing consistency is that their individual performances are affected differently by the same conditions. Statistically, their returns move in opposite directions. This inverse relationship is what we call negative covariance or negative correlation. One tends to go up and the other goes down, creating a natural hedge.
That's such a powerful and clear illustration. It really makes the point. So the trick to diversification working its magic is fundamentally that the investments don't all move in perfect lockstep. Or even better, if they actually move in opposite directions, like the resort and the umbrellas.
Precisely. As long as there isn't perfect positive co-movement among the profits of individual companies, diversification can reduce risk. Now, in our simple island example, the businesses are perfectly negatively correlated. One's gain is exactly the other's loss. That allows for complete risk elimination in theory. In the real world, of course, few companies are perfectly negatively correlated, and in fact, most tend to move in the same general direction, especially during a broad economic recession when almost everything gets hit.
Sure, yeah.
So while you won't eliminate all risk through diversification in the real world, you can still significantly reduce it compared to just holding one or two individual stocks.
Okay, so if you combine, say, shares of a big car manufacturer with one of its primary tire suppliers, that probably won't help much with diversification, right? Because their fates seem too intertwined by the same economic forces people buying cars.
Exactly. Their fortunes rise and fall together.
But if you combine that car manufacturer with maybe a government contractor that operates mostly in a persistently economically depressed region, that sounds like a much better approach to real diversification, doesn't it?
That's a great real-world example, yeah. If overall consumer spending falls, both the company like, say, GM and its tire supplier likely suffer. Their sales are tightly linked. But a government contractor? They might be significantly insulated from that specific downturn, especially if government contracts perhaps increase in depressed areas during times of high unemployment, maybe as a form of stimulus.
Ah, interesting.
Their profits might not move in sync at all, or they could even be negatively correlated in some scenarios. The crucial insight from Markowitz, and this is truly important for you as an investor, is that for risk-reducing benefits, the correlation doesn't have to be negative like our island example. It just has to be not perfectly positive, less than +1. That correlation coefficient, that number measuring how things move together, is absolutely central to determining whether adding an investment will effectively reduce your portfolio's overall risk.
Okay, this brings up an important practical question, though. Is there a point where adding more and more investments just stops helping? Can diversification truly be a magic wand forever? Or are there limits to how much risk it can actually mitigate?
Yeah, good question. And research suggests there is indeed a point of diminishing returns. If we're talking purely U.S. domestic stocks, studies found that about 50 well-diversified U.S. stocks of comparable size can significantly reduce overall portfolio risk, maybe by more than 60% compared to holding just one stock.
60%? Wow.
But beyond that number, maybe 50 or so, the benefits of adding more U.S. stocks really start to diminish quite quickly. You're just not getting much more risk reduction bang for your buck. But, and this is key, the world has certainly evolved since MPT was first formulated decades ago. We're much more global now.
Right. So if you're willing to look beyond just U.S. stocks, if you look globally, you can potentially get even more protection for your investments. This is where the theory truly shines in today's world, I think.
Absolutely. Foreign economies, particularly those in emerging markets, don't always move in perfect lockstep with the U.S. economy. For instance, think about rising oil prices. That might hurt Europe and Japan, which are large oil importers.
Yeah.
But it could significantly boost the economies and stock markets of oil-producing nations. This inherent lack of perfect synchronization means international diversification offers even greater risk reduction potential. Studies consistently show that for globally minded investors, that sort of golden number is still around 50 stocks. But when those 50 stocks are selected from both U.S. and international markets, they tend to offer superior capital protection compared to a U.S.-only portfolio.
So the takeaway is a globally diversified portfolio tends to be less risky than one made solely of U.S. stocks, even if some of those foreign markets seem riskier individually. And you've got some compelling data that truly brings that point home, don't you?
Yeah, if we look at historical returns, say from 1970 to 2013, foreign stocks, as measured by the EAAE index that's mostly developed markets outside North America, actually had slightly higher average annual returns than U.S. stocks over that long period.
Higher returns.
A bit higher, yeah. Now, U.S. stocks were certainly safer, meaning they exhibited less year-to-year volatility. But the correlation between the U.S. index and the EAE index was only around 0.5.
So positive, but not super high.
Exactly. Positive, but far from perfectly correlated. And that lack of perfect correlation means combining them creates powerful new risk-return possibilities for your portfolio. What's truly fascinating here and counterintuitive at first is that adding some of those individually riskier foreign stocks can actually reduce your portfolio's total risk level, at least up to a certain point, and potentially it can also increase your overall expected returns.
Okay, that does sound almost contradictory, doesn't it? Adding assets that are individually riskier to lower your portfolio's total risk. How does that actually work in practice?
It's not contradictory because of that crucial hedging effect we talked about. That lack of perfect correlation is key. Think about it. During periods when, say, Japanese automakers were rapidly gaining market share in the U.S. back in the 70s and 80s, the strong stock returns from those Japanese companies would naturally help offset weaker returns from U.S. auto stocks that were losing share.
Right. One balances the other out.
Or, conversely, maybe the U.S. economy is thriving and the dollar is strong while Japan and Europe are stuck in recession. In that case, strong returns from U.S. manufacturing companies can help offset poor performance from similar foreign manufacturers in your portfolio. That offsetting or hedging effect is what reduces the overall portfolio volatility, the wobble. Historically, research found that a portfolio composed of about 17% foreign stocks and 83% U.S. stocks was actually the least risky combination possible, using just those two asset classes. And interestingly, it also tended to slightly increase the portfolio's overall return compared to a 100% U.S. stock portfolio.
Less risk and potentially more return.
Exactly. That's why international diversification is often called something very close to a free lunch in the global investing markets. It's one of the few instances where you seem to get something for nothing.
But you do hear some portfolio managers argue today that globalization has increased correlations between markets, right? Making diversification maybe less effective than it used to be, especially during a big crisis like the financial crisis of 2007, 2009, when it seemed like everything went down together. Nowhere was safe. Is that a valid concern? Has the free lunch disappeared?
That raises a really important point, and certainly valid consideration. Correlations have generally increased between global markets over the last couple of decades. That's true. However, they are still far from being perfectly correlated, far from being +1. And critically, broad diversification still tends to reduce overall portfolio volatility, even if maybe the effect isn't quite as pronounced as it was 30 years ago. Take the early 2000s, for example. We mentioned it earlier, often called the lost decade for U.S. stock investors. During that period, the stock markets of the big developed countries, the U.S., Europe, Japan, they mostly stagnated or even fell over roughly 10 years. Pretty dismal.
Yeah, tough times.
However, investors who were globally diversified and, importantly, included emerging market stocks in their portfolios during that same period often saw excellent performance. So even in a very challenging decade for the major developed markets, broad international diversification, including emerging markets, offered significant gains and helped mitigate losses elsewhere.
That's a great point. And it's not just about diversifying among different types of stocks, is it? We shouldn't forget bonds. Safe bonds still play a vital role, too.
Absolutely. Bonds are crucial. During the severe financial crisis of 2008-2009, for example, something interesting happened with correlations. The correlation between long-term U.S. Treasury bonds and large-cap U.S. stocks actually dropped significantly. It became much less positive, even negative at times. And what's more, even during that incredibly sharp stock market decline in 2008, an investment in a broadly diversified U.S. bond portfolio actually yielded a positive return, over 5%, I believe.
Wow, positive when stocks were crashing.
Exactly. It clearly proved that high-quality bonds can be an effective place to hide during stock market turmoil. They remain a vital component of a truly diversified portfolio, especially when stocks are under severe stress. They provide that ballast.
Okay, so wrapping this up, what does this all mean for you, the listener, the investor? It means that the time-tested practice of diversification isn't just some old maxim passed down through generations. It's not just don't put all your eggs in one basket. It's a powerful, mathematically proven strategy that is just as relevant today as it ever was, maybe even more so, in our interconnected global economy. It's really about consciously building a portfolio, almost like designing an engineered risk-return machine rather than just, throwing darts at a board and hoping for the best.
That's well put. Understanding how different assets, we're talking domestic stocks, international stocks, emerging market stocks, and yes, even different types of bonds, how they interact within a portfolio. That understanding allows you to build a strategy that consciously aligns your personal tolerance for risk with your long-term return goals. It's fundamentally about intelligently shaping your investment journey rather than just hoping for the best or relying entirely on simple luck or market timing.
It truly is a shortcut to being well-informed, I think, allowing you to approach your investments with much greater confidence and clarity. So here's a provocative thought for you to consider as we finish up. Given everything we've just discussed about modern portfolio theory and the power of correlation, what kind of correlation are you actually hoping for among the different assets in your own investment choices? And how might really thinking about that fundamentally change the way you approach building or adjusting your portfolio in the future? We're the show that takes a pile of research and, well, digs through it to find those key insights you really need.
That's the goal.
And today, we're tackling something pretty fundamental in finance. The idea that, with risk comes reward. Everyone sort of knows that.
It's almost intuitive, yeah.
But the real kicker, the million-dollar question, is how do we actually measure that risk? And maybe more importantly, how do we use that measurement to try and get higher returns?
It's a huge puzzle. People have understood the trade-off forever, basically. But the tools to really quantify it, that's much more recent history.
Exactly. And that's our deep dive today, how we went from just intuition to these analytical models. We're going to trace that thinking, from the early stuff right through to the famous beta and what came after, all based on the sources we've gathered.
Yeah, and our mission, really, for you listening, is to cut through the complexity. We want to give you a clear path to understanding risk measurement in investing.
Sorting through the theories, the tools, how they actually worked out in the real world.
All right. Hopefully you walk away well-informed, maybe with a few moments along the way.
Okay, let's dive in. The story really starts, or at least this part of it, with modern portfolio theory, MPT. You've talked about it before. Diversification is key, right?
Absolutely. MPT showed how powerful diversification is. But, and this is crucial, it can't wipe out all the risk when you're actually investing.
Not like in those simplified examples, like the fictional island economy, where everything was perfectly independent.
Exactly. In the real world, stocks kind of move together.
Yeah.
They, share the ups and downs. So diversification helps, it reduces risk, but it doesn't eliminate it.
And realizing that limitation, that led directly to the capital asset pricing model, or CAPM. We've got some brilliant people involved here. William Sharpe, John Littner, Fisher Black.
They really focus on that question. Which risks can you diversify away, and which ones are you just stuck with?
And Sharpe even got a Nobel Prize for this work in 1990, shared with Markowitz.
He did. And the core idea of CAPM is pretty elegant, really. It says, look, the market is going to reward you. You won't get a premium return. For bearing risks, you could have diversified away easily.
Right, because why should it? Anyone can do that.
Precisely. So if you want higher long-term average returns,
right,
CAPM says you have to take on more of the risk that cannot be diversified away. That's the only risk that pays.
Okay, so let's break down risk then, according to these theories. What are the actual components?
Good question. They start with total risk. That's just the overall ups and downs, the variability or standard deviation of a stock's returns. Simple enough.
Okay.
But the insight is splitting that total risk into two pieces: systematic risk and non-systematic risk.
And the difference is?
Systematic risk, people also call it market risk. That's the risk that comes from just being in the market. General volatility, the fact that most stocks tend to go up or down with the overall market trend.
And that's the part you can't get rid of through diversification.
Exactly. No matter how many different stocks you own, you're still exposed to the whole market moving.
Okay, so that's systematic. What about non-systematic?
Non-systematic risk is about factors unique to one specific company. Think a surprise strike, or maybe they discover a huge new product, or, unfortunately, things like accounting fraud.
Stuff that hits one company, but not necessarily the whole market.
Right. And the good news here is this type of risk can be significantly reduced, even almost eliminated, by diversifying, by holding lots of different stocks.
Which brings us to maybe the most famous Greek letter in finance, beta.
Yes, beta. It's basically the number they came up with to describe that systematic risk. It measures how sensitive an individual stock or even a whole portfolio is to those overall market movements.
It quantifies that relative volatility, right, based on past data.
Correct. Estimated from historical patterns.
So how does it work in practice? Like, what do the numbers mean?
Well, think of the broad market itself. Say the S&P 500 index as having a beta of 1. That's the baseline. Now, a stock with a beta of 2, well, that means it tends to be twice as volatile as the market. If the market goes up 10%, this stock tends to go up 20%. Professionals would call that an aggressive investment.
More risk, potentially more reward on the upside, but also more downside.
Exactly. And conversely, a stock with a beta of 0.5 would be less volatile. Market up 10%, maybe it's only at 5%. That's a defensive investment.
And this really shows that diversification point again if you add more stocks.
Yeah, as you add more and more different stocks to your portfolio, that company-specific, non-systematic risk starts to cancel itself out pretty quickly.
The sources say with about 30 stocks, a lot of it's gone. And with 60 or more, it's practically eliminated.
Virtually eliminated, yes.
Yeah.
At that point, the portfolio's total risk is essentially just its systematic risk, the market risk.
Okay, now this is the crucial step in CAPM, isn't it? Only that systematic risk gets compensated.
That's the core claim. Investors should get paid for taking on risk. Everyone agrees on that. But CAPM argues, because you can easily diversify away the non-systematic part.
You get no extra return for holding on to it?
Correct. The only risk that commands a risk premium, that extra expected return, is the systematic risk you can't avoid through diversification.
Let's try an example. Say you have two groups of stocks, Group 1 and Group 2, 60 stocks each.
Okay.
And let's say every single stock in both groups has a beta of 1, so they all have average market sensitivity.
All right, same systematic risk profile across the board.
But suppose the stocks in Group 1 have really high specific risk, lots of company-unique volatility, while Group 2 stocks have very low specific risk.
Okay, so Group 1 has higher total risk stock by stock.
Right. But according to CAPM, if you build diversified portfolios using 60 stocks from either group,
they should have the same expected return.
even though Group 1 stocks are individually riskier overall.
Yes, because in a 60-stock portfolio, that high non-systematic risk in Group 1 has been diversified away, just like the low non-systematic risk in Group 2. What's left is the systematic risk, the beta of 1, which is the same for both.
And if Group 1 somehow offered higher returns temporarily?
Rational investors would pile in, buy those stocks, pushing prices up and returns down until they matched Group 2. Equilibrium.
So the theory paints this really neat picture, a straight line. More systematic risk, measured by beta, means higher expected return.
Exactly. A linear relationship.
Yeah.
Beta of 0, like government-insured savings. You get the risk-free rate.
Makes sense. No risk, lowest return.
A beta of 1, like a market index fund. You expect the average market return, but you're taking that market risk.
And you can aim for different betas, right? Buy high beta stocks or even use leverage like buying average stocks on margin.
Yep, buying on margin increases your portfolio's sensitivity to the market, effectively increasing its beta, along with both potential return and risk.
Okay, so this theory emerges, it's mathematically elegant, and then what happened? It seems like beta really took off.
Oh, it absolutely did. In the early 1970s, beta became, well, you said it, all the rage. It was everywhere.
Institutional Investor magazine even put the fashionable beta on its cover.
They did. And they commented how fund managers, maybe not the most max-savvy group generally, were suddenly talking about beta like they were statisticians.
Why the sudden excitement? What drove that?
It felt rigorous, scientific, a way to finally quantify risk properly. And it got a big boost when the SEC, the Securities and Exchange Commission, endorsed it as a valid risk measure.
So Wall Street being Wall Street, they jumped on it.
Naturally. Firms started churning out beta measurement services like a badge of honor showing you were sophisticated, up to date. Yeah. And you still see it today. Merrill Lynch, Value Line, Morningstar, they all provide beta estimates.
And the initial thinking was pretty straightforward. Buy high beta, get high returns. Or maybe time the market with it.
That was the hope. Buy high beta stocks when you think the market's going up, switch to low beta when you think it's heading down. Simple, right?
It sounds simple. But then comes the reality check. I love that Shakespeare quote you mentioned. I can call spirits from the vasty deep.
Ah, yes. Hotspur's reply to Glendower and Henry IV. Why, so can I, or so can any man. But will they come when you do call for them?
Exactly. You can create a theory, but does it actually work? Does the real world behave that way?
That's always the ultimate test. And beta also became this huge tool for evaluating money managers.
Right, the search for alpha. If your return beat what your portfolio's beta predicted, you were a star.
You generated positive alpha. Everyone wanted alpha. But then came the empirical evidence.
This is where Eugene Fama and Kenneth French come back in with that big 1992 study.
Yes, a really landmark study. They looked at basically all traded stocks from 1963 to 1990, decades of data. And they grouped them into 10 portfolios, 10 deciles, based on their measured beta, low beta in one group, high beta in the 10th group, and everything in between.
Okay, so they lined them up by beta. What did they find when they looked at the actual returns of those portfolios over that long period?
The findings were, well, they were stunning, frankly. Fama and French found there was, and I quote, virtually no relationship between the returns of these decile portfolios and their betas.
Wow. So the high beta portfolios didn't consistently outperform the low beta ones?
Not in the way that lined up with the theory. Flat. No real pattern. And they found similar results when looking at actual mutual fund returns, too.
So this huge study, covering almost 30 years, it basically said CAPM's core prediction about beta and return didn't hold up.
Pretty much. They concluded that beta, as used in CAPM, just wasn't a useful way to explain the actual differences in stock returns they observed.
That must have sent shockwaves through the financial world. The capital asset pricing model is dead. That's a strong statement.
It was huge. By the mid-90s, you saw headlines like, "The death of beta, goodbye beta, beta's defeat." That quote from the accomplished quant and institutional investor captured the mood. There's a seismic event. The capital asset pricing model is dead.
People were ready to just toss beta in the trash heap.
Many academics and practitioners certainly did. It seemed like the evidence was overwhelming.
But you argue that reports of beta's death were maybe a bit hasty, premature. Why?
Well, I think there are good reasons not to dismiss this entirely. For one thing, beta does capture something meaningful about risk.
Meaning,
most people would agree that stable returns are better than volatile ones, all else equal. And beta is a measure of relative volatility. It tells you how much something bounces around compared to the market.
okay, so it measures volatility, which is one aspect of risk people care about.
And statistically, portfolio beta values actually do a decent job of predicting future relative volatility. They might not predict future returns well, but they predict future bounciness reasonably well.
Interesting distinction. What else?
Second, there are real challenges in measuring beta accurately. Richard Roll at UCLA made a powerful point early on. What is the market?
Ah, right. It's not just the S&P 500?
Not even close. Think about it. There are thousands of other U.S. stocks, foreign stocks, bonds, real estate, commodities, even, arguably, our own skills and earning potential human capital.
That's incredibly broad. How could you possibly capture all that in one index?
Exactly. And how you define and measure that market drastically affects the beta numbers you calculate for any given stock. So maybe the theory isn't wrong, but our measurement of the key variable is flawed.
And didn't some later research actually support that idea? Something about human capital and economic cycles?
Yes. Jagannathan and Wang published work suggesting that if you broaden the market index definition to include human capital, and if you allow beta itself to change depending on the state of the economy.
Which seems plausible, right? A company's sensitivity might change in a recession versus a boom.
Very plausible. If you do those things, they found that suddenly CAPM and beta look much, much better as predictors of returns. Strong support, actually.
So maybe it wasn't dead, just misunderstood or mismeasured.
Could be. And the third point is, even if beta doesn't predict long-term returns perfectly as measured conventionally, it can still be a useful tool for managing a portfolio.
How so?
Well, let's imagine for a moment that the Fama-French finding holds that low beta stocks give you returns just as good as high beta stocks on average. Now, that's a big if for an investor to rely on, but if it's true,
Then you could just choose low beta stocks and get the same return with less volatility, less risk.
potentially. Or you could take those low beta stocks, buy them on margin to lever up your exposure, aiming to match the risk level of high beta stocks, but potentially achieving a higher return.
Interesting ways to think about using it, even with its flaws.
Right. So the bottom line for me is beta, measured the standard way, isn't a magic wand. It's not a substitute for thinking carefully. You can't just blindly use it to predict long-term returns, but reports of its complete death. Probably premature.
Okay, so beta isn't perfect, maybe flawed in its common application, but not useless. Where did the search for better risk measures go next, if one factor isn't enough?
Maybe you need more factors. This led to arbitrage pricing theory, or APT. Stephen Ross was a key figure here, another pioneer.
And APT agrees with CAPM on the basic principle.
Yes, it still holds that only systematic, non-diversifiable risks should earn a premium return. That part is consistent.
But its main insight was that just using one beta tied to a single market index might be too simplistic.
Exactly. Ross argued that a stock's risk isn't just about how it moves with the S&P 500, for example. There could be multiple systematic factors influencing returns, things that affect broad swaths of the economy, but maybe not all in the same way as a single market index.
Like what kind of factors? Give us some examples.
Well, think about changes in national income or overall economic growth. A recession hits most companies, right? That's systematic.
Yep. Sure.
But it might hit some sectors harder than others. Remember that GM worker holding GM stock? A downturn hits their job and their stock that linked to national income is a specific systematic risk for them.
Okay, that makes sense. What else?
Changes in interest rates. When rates go up, generally, stock prices tend to go down as future earnings are discounted more heavily. But some stocks, like utilities or highly indebted companies, are way more sensitive to interest rate changes than others.
Another systematic factor, but with varying impact.
Right, and changes in the inflation rate, too. Unexpected inflation can hurt companies by raising costs, or it can lead to higher interest rates, which hurt stock prices. But then again, companies dealing in natural resources might actually benefit from inflation.
So APT says, instead of just one beta, we need to measure a stock's sensitivity to several of these systematic factors: national income, interest rates, inflation, maybe others.
That's the idea. By using multiple sensitivity measures, multiple betas, if you will, APT tries to explain the differences in stock returns more accurately than the single-factor CAPM. Although fairness requires admitting, APT runs into some of the same practical measurement problems as CPM. Defining and measuring these factors precisely isn't easy.
Which brings us back to Fama and French. After showing beta's weaknesses, they proposed their own multi-factor model, right? The three-factor model.
They did. It's similar in spirit to APT, acknowledging multiple risk factors. But instead of deriving them purely from economic theory, they added two factors based on their empirical findings about what seemed to predict returns historically.
So they kept the original market beta.
Yes, market beta was still factor one, but they added company size, usually measured by market capitalization.
By size.
They observed consistently that smaller companies tended to have higher average returns than large companies over long periods. The thinking is, maybe smaller firms are inherently riskier. Perhaps they're less established, struggle more in downturns, have less access to capital.
So a small cap premium potentially linked to risk. What was the third factor?
The book-to-market ratio, that's a company's accounting book value divided by its market value. They found that stocks with high book-to-market ratios, often called value stocks, tended to outperform stocks with low book-to-market ratios, or growth stocks.
And the rationale there, why would that relate to risk?
Well, a high book-to-market ratio often means the market doesn't value the company much higher than its raw assets or accounting value. Sometimes this is seen as a sign of financial distress or perceived higher risk. Think about those big banks in early 2009 trading way below book value. Investors clearly saw them as risky.
So size and value, book to market, were added to market beta based on historical return patterns.
Exactly. Now, there's still debate about whether size and value are truly capturing risk premiums, or maybe they reflect some kind of market inefficiency or behavioral bias. But the empirical link to returns has been pretty strong historically.
And the field didn't stop at three factors, did it? People keep adding more.
Oh yeah, the quest continues. You see models now with even more factors. There's often a momentum factor, the observation that stocks that have been going up tend to keep going up for a while, and vice versa.
That one seems less like fundamental risk, maybe more behavioral.
Perhaps. There's also often a liquidity factor, the idea that investors need a higher return to compensate them for holding stocks that are hard to buy or sell quickly.
That makes intuitive sense as a risk.
And some models even include a company quality factor, looking at things like stable earnings, strong balance sheets, low debt. The idea is higher quality means lower risk.
So these multi-factor models, whether APT-based or Fama-French style, are pretty common now.
Very common. They're widely used to evaluate portfolio performance. Did a manager just get lucky with market beta, Or did they successfully tilt toward size, value, or other factors? And crucially, they're used to design investment strategies, particularly smart beta funds.
Ah, smart beta. Trying to capture those factor premiums directly.
Exactly. Building portfolios that deliberately target exposure to size, value, momentum, quality, low volatility, whatever factors you believe will generate excess returns over the long haul, presumably as compensation for bearing those specific risks.
So wrapping this all up, what's the big takeaway for you listening to this? It seems clear the market is pretty efficient. Getting lasting returns just from, say, charting patterns or basic company analysis is really tough.
It really is. The evidence suggests the market digests information very quickly, which leads back to that core idea. The most reliable path, maybe the only path, to potentially higher long-term returns is by taking on more risk.
And it's a big but. We still don't have one single perfect way to measure that risk. Beta, the original breakthrough, has real issues. It can be unstable, depends heavily on how you measure the market, and historically didn't correlate with returns the way CAPM predicted.
Right. And the move to multi-factor models like APT and Fama-French acknowledges that reality. Risk is complex. It's not just about overall market movement.
It seems stock returns are sensitive to a whole cocktail of things. The market, interest rates, inflation, economic growth, exchange rates, plus these company characteristics like size and value.
It's a complicated picture. No single number captures it all. The holy grail of a perfect simple risk measure. It's still elusive.
So maybe the real insight here is that the complexity itself is the point. That trying to find one simple answer is missing the nature of the market.
Could be. And it means, for you, there's no magic formula. No handsome genie is going to pop out and solve all your investment problems with one perfect risk number.
If anything, the tools are getting more complex, not simpler.
That seems to be the trend. Which reminds me of that great story Robert Kirby used to tell
Yeah.
about the old woman granted 3 wishes by a genie. First wish, she turns her old rocking chair into solid gold.
Nice start.
Second wish, she turns herself into a beautiful young maiden.
Even better.
And for her third wish, she asks the genie to turn her beloved cat into a handsome young prince.
Okay.
Poof. The prince appears. He's incredibly handsome. He looks at the now young and beautiful woman, leans in close, and asks,
What?
"Now, aren't you sorry you had me castrated?"
Ah, right. A good reminder that even when you think you've found the perfect solution, there are often unforeseen consequences or complications. No simple answer solves everything, especially in finance.
Have you ever made a decision, maybe something small like dinner, or, a big life choice, and later thought, what was I thinking? That was completely irrational.
We all have, right?
Of course,
Yeah.
you all do it. But what if those distinctly human quirks, those biases, actually have a massive impact on something like the stock market?
Something that seems so logical on the surface.
Exactly. Today, we're doing a deep dive into behavioral finance, our mission, to figure out why traditional finance assumed we're all perfectly rational. How this newer school of thought challenges that, revealing the very human side of investing, and, most importantly, what it all means for your financial decisions.
Yeah, and for a long time, the big theories in finance, things like the efficient market hypothesis.
Right, the idea you can't beat the market consistently.
Precisely. And modern portfolio theory, guiding diversification, they were all built on this bedrock idea. Investors are rational, always trying to maximize wealth, always aware of risk.
Okay, but what about when people aren't rational? Which is like often.
Well, economists had a sort of escape hatch for that. They figured, okay, maybe some individuals act irrationally, but it'll all cancel out in the aggregate.
Ah, the random noise idea.
Or that savvy traders, the arbitrageurs, would quickly step in and correct any mispricing caused by irrationality.
But then things started to shift, didn't they? Early 21st century.
They did. A new school, you could say, of financiers emerged. And their argument was pretty bold.
What was it?
Basically that people are not fully rational, even with money. Meir Statman put it very directly. He said, behavioral finance is not a branch, it is a replacement. It better describes human nature.
Wow, a replacement. That's a strong claim.
It is. And a lot of this momentum came from the work of 2 psychologists, Daniel Kahneman and Amos Tversky. They really fiercely attacked the economists' views.
Their idea being people just aren't as logical as the models assumed.
Exactly. Seems like common sense now, perhaps, but it took, well, over 20 years for it to gain wide acceptance in academia.
20 years.
Yeah. And tragically, Tversky passed away before Kahneman received the Nobel Prize in economics in 2002 for their joint work.
Wow.
Kahneman himself said it was really a prize for both of them. He regretted Tversky couldn't be honored too. Their insights, though, they've spread everywhere now. Social sciences, economics, business schools.
Okay, so fascinating stuff for academics. But, for the rest of us trying to invest, what's the practical takeaway? How does behavioral finance help us?
Well, behavioral financiers argue market prices aren't as precise as traditional theory claimed. And here's the real kicker.
Okay.
The irrational trades people make, they aren't just random. They often move together, they're correlated, and you can actually sort of quantify this irrationality.
So it's not just random noise canceling out.
No. And we can group these behaviors into 4 main factors that show how this happens: overconfidence, biased judgments, herding, and loss aversion. We should probably dig into those.
Yeah, let's do it. Where do we start?
Let's start with overconfidence. Cognitive psychologists find this again and again. When we make judgments under uncertainty, we tend to deviate from pure rationality.
How so?
The most common bias. We're just overly confident in our own abilities and too optimistic about the future.
Okay, yeah, that rings a bell. Give me an example.
Right, the classic driving example. Ask university students how they rate their driving versus their peers. 80–90% will say they're better, safer drivers. It's the Lake Wobegon effect, where everyone's above average.
Right. Mathematically impossible, but we all feel it.
Exactly. Or ask students about their own future career, marriage, health. They'll paint a rosy picture. Then ask about their roommate's future.
Suddenly more realistic. Less positive.
Much more. And get this, a study with adult men rating social skills, 100% put themselves in the top half.
100%, no way.
Yep. And a quarter thought they were in the top 1%. Even athletic ability, 60% put themselves in the top quarter. Our brains just love to tell us we're great.
Okay, so how does that specifically play out with investing?
Well, research shows investors really tend to overstate their skills. They underestimate the risks involved and exaggerate how much control they actually have. There was this experiment, a confidence interval one. Investors had to estimate a range for the Dow, say a month out. They had to be 99% sure the actual number would fall in their range.
So they should only be wrong, 1% of the time? Or 2% if you count both ends?
Right, something like that. But the actual outcomes, they fell outside the range nearly 20% of the time.
Wow. That's a big difference.
Huge overconfidence. It's just, if someone tells you they're 99% sure about a market call, they should probably dial that back to maybe 80% sure.
Good rule of thumb.
And interestingly, men often show more overconfidence than women in money matters.
So what's the damage? What does this do to your portfolio?
Well, this misplaced confidence leads a lot of individual investors to think they can beat the market. So they speculate, they trade way too much.
Chasing returns, trying to time things.
Exactly. And studies by Terrence O'Dean and Brad Barber looking at actual brokerage accounts found the more people traded, the worse their performance was.
Ouch.
And guess who traded more and did worse?
Let me guess. Men.
Bingo. And this illusion of skill gets fueled by something called hindsight bias.
The I knew it all along effect.
Precisely. You remember your winners? Oh, I knew Google would triple after the IPO. And conveniently forget the losers. It inflates your confidence.
So the takeaway is, don't mistake luck for skill.
Definitely not. As Steve Forbes' grandfather apparently said, you make more money selling advice than following it.
Good one.
And this overconfidence in predicting growth, it often leads investors to overpay for so-called growth stocks.
The exciting new companies.
Right. The predictions are often too rosy, they don't materialize, and those stocks can actually underperform the less exciting value stocks over time.
Okay, brain playing tricks again. Let's move to the next one. Biased judgments.
Right. This is where the illusion of control really comes in. Investors start seeing patterns or trends that just aren't there.
Like seeing shapes in clouds.
Kind of. There's a great example from a stats professor. He'd ask students to imagine flipping a coin 100 times and write down the results. HT, whatever.
Okay.
Then one student would actually flip a coin 100 times. The professor could always tell which sequence was real.
How?
The real one nearly always had longer streaks like HHH or TTTTT than the students imagined. Our brains expect randomness to look, well, more alternating, like HTHTHT. We misunderstand true randomness.
That makes sense. We impose patterns.
We do. And this illusion of control runs deep. One study had people thinking they were controlling a ball on a screen, but the controller was disconnected.
Seriously.
Yep. They were convinced they had control. Except, interestingly, subjects diagnosed with severe depression, they didn't have the illusion.
Wow. That's telling.
Another one.
Yeah.
Baseball cards for a lottery. People valued a card they chose themselves higher than an identical card they were just given.
Even though the odds were identical.
Identical. It's why lotteries let you pick numbers. It feeds that feeling of control. And for investors, the danger is believing you can spot patterns in stock prices when it's mostly just random fluctuation or random walk.
So you think you see a trend, but it's probably just noise.
Very likely. And this ties into the representativeness heuristic. Fancy term.
Break it down for us.
Okay. It means we often substitute similarity for actual probability. The classic is the Linda problem.
Linda.
Yeah. They describe Linda, 31, single, bright, philosophy major, concerned with social justice, anti-nuclear activist.
Okay, painting a picture.
Then they ask, is it more likely Linda is A, a bank teller, or B, a bank teller and active in the feminist movement?
Based on the description, B sounds more likely.
And that's what over 85% of people say. But think about it probabilistically. Everyone who fits category B must also fit category A.
Ah, right. You can't be B without being A. So A has to be more probable.
Exactly. But because the description seems representative of a feminist, our brains jump to B. For investors, this means we might chase a story stock or a hot fund because the narrative feels right even if the numbers don't back it up. Similarity trumps probability.
Okay, that's a really clear example of how a mental shortcut can lead you astray. Let's shift gears to herding, following the crowd.
Right. Now, groups can make good decisions if information is shared well, but sometimes it goes wrong, pathologically wrong.
Right.
Tulip bulbs in the 17th century, the dot-com bubble more recently, it's groupthink people influencing each other into believing something incorrect.
There was that famous experiment, right, with the line.
Solomon Asch, 1950s, classic. People had to judge line length, super simple. But most participants were secretly told to give the wrong answer.
And the real subject.
Often went along with the clearly wrong answer, just due to social pressure.
Even when their own eyes told them otherwise. That's powerful.
It is. And a later fMRI study by Gregory Burns in 2005 added another layer. When people conformed, the activity wasn't just in social processing areas, it was in spatial cognition areas.
Okay.
It suggests their actual perception might have changed. They weren't just giving in, they might have started to see the lines the way the group did. The errors of others can literally change how you see the world.
Wow.
Think about this. One person looking up at an empty sky, a few people might glance over. 5 people looking up attracts 4 times as many onlookers. 15 people, almost half the passers-by, stop and look up.
The power of the crowd.
Absolutely. And the dot-com bubble is a prime example in investing. Irrational herd mentality took over.
People buying just because prices were rising and their friends were getting rich.
Exactly. Charles Kindleberger nailed it. Nothing is more disturbing than to see a friend get rich. Robert Shiller called it a positive feedback loop.
Almost like a Ponzi scheme.
In a way, initial price rises pull in more buyers, pushing prices higher, pulling in even more until you run out of greater fools.
And it's not just novice investors caught up in this, right? Professionals, too.
Oh, definitely. Studies show fund managers in the same city tend to hold similar stocks. They follow the crowd, too.
And the consequences for individuals.
Often devastating, because the average investor tends to pile into stock funds when the market's near a peak, like leading up to March 2000.
When everyone's euphoric.
And they pull money out when the market's near a bottom fall of 2002, fall of 2008.
Buying high, selling low. The classic mistake.
Exactly. Data suggests this bad timing costs the average investor over 5% per year compared to just holding the market. Plus, there's the penalty for choosing the wrong fund chasing growth in 2000, right before value took off.
So the lesson is, don't follow the herd. Resist that FOMO.
It's crucial. It almost always leads you astray.
Okay, let's tackle the big one. Kahneman and Tversky's greatest contribution, you said. Prospect theory.
Yes. This really challenges the old idea that we make decisions based on our overall wealth.
So it's not about the total dollar amount.
Not directly. Prospect theory says our choices are driven by the value we assign to gains and losses, relative to some reference point. And crucially, losses hurt much more than equivalent gains feel good.
Okay, explain that. Losses hurt more.
Think about a simple coin flip bet. Heads, you win $100. Tails, you lose $100. Fair bet, right? 50-50.
Mathematically, yes.
But most people won't take it. Kahneman and Tversky found they needed the potential win to be around $250 to get people interested in risking that $100 loss.
So the pain of losing $100 is like 2.5 times stronger than the pleasure of winning $100?
Roughly, yes. The pain of losing $1 is about 2.5 times the pleasure of gaining $1. This loss aversion is a powerful force.
That explains a lot. But you also mentioned a paradox,
Yeah.
that people become risk-seeking sometimes.
Right, specifically when facing a certain loss. Imagine you have two choices. Option A is a guaranteed loss of $750.
Ouch.
Option B is a gamble, a 75% chance of losing $1,000, but a 25% chance of losing nothing.
The expected loss is the same, $750 for both.
Correct. But faced with that certain $750 loss, nearly 90% chose the gamble, option B. They became risk-seeking to avoid the certainty of a loss.
Willing to risk a bigger loss for a chance to avoid any loss at all.
Precisely. And this ties into the framing effect. How you state the choice matters immensely.
Give us the example, the disease outbreak.
Yes. Imagine 600 people are expected to die. Frame 1, saving lives. Program A saves 200 people for sure. Program B has a 13 chance of saving all 600, 23 chance of saving no one.
Okay, A is the safe bet, B is the gamble.
And most people chose A, the certain 200 saved, risk aversion.
Okay.
Now, frame 2, people dying. Program A means 400 people will die for sure. Program B means a 13 chance no one dies, 23 chance all 600 die.
Wait, that's the exact same outcome as before, just worded differently. A and A are identical outcomes. B and B are identical.
Exactly the same, but framed in terms of dying. Over 75% chose the gamble, program B. They became risk-seeking to avoid the certainty of 400 deaths.
Wow, just changing the words from save to will die
Yeah.
flipped the preference completely.
Completely. It shows how powerfully framing affects our choices, even when the underlying reality is the same. Doctors face this with cancer treatments all the time.
So the lesson is, be aware of how investment choices are presented to you.
Absolutely. Now, tied into this are emotions like pride and regret.
Ah, the emotional side.
Behavioral finance people stress how much these influence us. It's hard to admit a mistake, right? Especially telling your spouse you lost money on that stock tip.
Yeah, that's a tough conversation.
But successes, we love to share those. Makes us feel smart, validated.
So that feeling, that need to feel pride and avoid regret, actually messes with our investment decisions.
Big time. It leads to the disposition effect. Barber and Odin found this looking at trading records.
What's the effect?
Investors have a strong tendency to sell their winners too early to lock in that gain and feel the pride.
Okay.
And they hang on to their losers for too long, reluctant to sell and face the regret of realizing that loss.
Isn't that the opposite of what you should do rationally? Especially for taxes.
Exactly. Selling winners triggers capital gains taxes. Selling losers can give you a tax deduction. Plus, a loss on paper is still a real loss. Holding on to a loser is effectively deciding to buy it again today at its current lower price.
Right. You wouldn't buy it today, so why hold it?
Pride and regret override that logic. You see it in housing markets too. When prices fall, people hate selling at a loss, so sales volume dries up.
Don't let pride or regret be your portfolio manager.
Excellent way to put it.
Okay, can behavioral finance also explain things like why people don't save enough for retirement, like in 401k?
It definitely offers insights. Even with a company match, which is free money, participation isn't always 100%. Why?
Loss aversion again.
Partly. Contributing feels like a loss from your current paycheck, your current spending power. Combine that with, basic self-control issues, procrastination, just sticking with the status quo.
The path of least resistance is often doing nothing.
Exactly. So it's understandable why savings rates can be low.
But there are solutions, right?
Right.
Behavioral finance-inspired fixes.
Yes, two really clever ones stand out. First, just change the default. Instead of opt-in enrollment for 401k.
Make it opt-out, automatic enrollment.
Right. If you're automatically enrolled and have to actively choose to get out, participation rates shoot way up. It leverages inertia.
Simple but effective. What's the second one?
The Save More Tomorrow plan from Thaler and Bernarzi. Brilliant idea.
How does it work?
Employees agree now to commit a portion of their future raises to retirement savings.
So it doesn't feel like a loss today.
Exactly. It sidesteps loss aversion because your current take-home pay doesn't decrease. And then inertia works for you as you get raises. Your savings rate automatically increases without you having to do anything more.
Did it work in practice?
Amazingly well. The first company to try it back in '98, over 3/4 joined, and over 80% stuck with it through multiple raises, ending up saving significantly more.
So small nudges, small changes in framing can make a huge difference.
Huge difference in long-term financial health.
Okay, but what about the efficient market folks? Their argument is that even if individuals are irrational, the smart money, the arbitragers, will fix it.
That's a classical argument. But behavioral financiers say, hold on, there are actually severe constraints on arbitrage. It's not that easy to correct mispricings.
What kind of constraints? Arbitrage sounds like a sure thing on paper.
Far from it. First, there's fundamental risk. Let's say you identify an overpriced stock, maybe in tech, and you short it. And you buy an underpriced one, maybe in energy, to hedge.
Okay, sounds smart.
But what if the tech company gets a surprise huge contract? Or the energy company has a sudden political problem? The mispricing could get worse before it gets better, and you lose on both sides.
Right. The real world can interfere with the theory.
Then there's noise trader risk. This is key. It basically means the market can stay irrational longer than the arbitrager can stay solvent.
The famous Keynes quote.
Essentially, yes. Think about long-term capital management, LTCM. Hedge fund run by Nobel laureates. Super sophisticated models.
And it blew up spectacularly.
Because markets moved against their supposedly hedged positions during the Russian debt crisis, and they ran out of capital before things could revert to normal, even the smartest guys can get wiped out by sustained irrationality.
That's a sobering thought. So the market can stay wrong longer than you can stay in the game.
It absolutely can. And get this, during the dot-com bubble, studies found sophisticated hedge funds weren't shorting the crazy tech stocks.
They weren't correcting the bug.
They were net buyers. They were riding the wave, maybe even helping inflate it.
Why would they do that if they knew it was a bubble?
Maybe because of that Keynes beauty contest idea. It's not about picking the stock you think is best, but the one you think others will find attractive next week, even if it's overpriced. Ride the momentum, then try to get out. They did similar things in the mid-2000s oil price spike, too.
Wow. So even the pros aren't always the correcting force.
Not always. And finally, there are practical implementation costs and restrictions. Short selling isn't always easy. Sometimes you literally can't find shares to borrow.
The mechanics get in the way.
Or finding a perfect substitute stock to head your bet can be really difficult. The classic example is Royal Dutch and Shell.
The Siamese twins.
Right. They agreed to split profits 60-40 Royal Dutch Shell. So Royal Dutch's total market value should always be 1.5 times Shell's.
Makes sense.
But for years, Royal Dutch often traded at a premium way above that, sometimes 20% higher. Arbitraging that seems easy, but it was risky because the premium could just keep widening. Short-selling constraints also played a role in inflating the housing bubble.
Okay, so arbitrage isn't the perfect market-correcting mechanism theory suggests.
There are significant limits. The market isn't always perfectly efficient.
So let's bring this home. What does all this mean for you, the individual investor? If the pros can't always fix it and our own brains are tricking us, what do we do?
Well, the biggest lesson, maybe, is that investors are often their own worst enemy.
Like Pogo said, we have met the enemy and he is us.
Exactly. It sounds harsh, but understanding these biases, these illusions and delusions is the first step to avoiding them. It's like that poker saying.
If you sit down and can't spot the sucker,
get up, because you are the sucker. Behavioral finance helps you not be the sucker at the investment table.
Charles Ellis made that comparison to amateur tennis, right? In winning the loser's game.
Yes. He argued amateur tennis isn't won by brilliant shots, it's won because the opponent makes mistakes. Investing, he says, is a loser's game like that. The best strategy for most people is often just not losing.
Which often means
a passive buy-and-hold index strategy. Because active strategies, especially frequent trading, often lead to self-inflicted wounds.
Right. You mentioned the studies showing frequent traders underperform significantly.
Dramatically. That Barber and Odin study showed active traders lagging the market by over 6 percentage points a year on average. Warren Buffett's advice. Near sloth-like inaction, he says the correct holding period is forever.
Odin even joked that married men should ask their wives before trading.
He did, maybe tapping into that potentially lower overconfidence. The core message is clear. Less is often more when it comes to trading.
Okay, so let's list some of these stupid investor tricks to avoid, based on everything we've discussed.
Right. Number 1, avoid herd behavior. We know friends and family influence decisions, but chasing what's hot rarely works out.
Gold, Japan, internet stocks, condos. The list goes on.
Right. Hot stocks or funds of one period are often the losers of the next. And remember that devastating cost of bad market timing, buying peaks, selling troughs, and choosing the wrong fund type at the wrong time.
Okay, avoid the herd. What's next?
2, avoid overtrading. The costs, commissions, taxes add up, and the evidence shows it hurts returns, not helps them. Think Buffett's forever, period.
Got it. Less action.
3, and this is the one that fights pride and regret. If you must trade, sell losers, not winners.
Counterintuitive, but makes sense for taxes and rationality. Don't let emotions dictate selling.
Exactly. A paper loss is real. Cut it loose if the rationale for holding is gone.
Okay, what else? Other specific tricks?
Yeah, a few more quick ones.
Lay 'em on us.
Be wary of new issues, IPOs, initial public offerings. Historically, they underperform the market significantly over the first few years.
Why is that?
Well, the companies going public are often doing it when they can get the highest price. And individual investors, you never get the really good IPOs at the initial offering price. Those go to institutions. You get offered the leftovers, the ones the pros didn't want as much.
So steer clear of the IPO hype.
Generally, yes. No other strategy is more likely to endanger your wealth. Strong words, but often true.
Okay, what else?
Stay cool to hot tips. You know, Uncle Gene's can't miss stock, your neighbor's sure thing.
The ones whispered breathlessly.
Okay, exactly. The old maxim. Never buy anything from a person who is out of breath. Ignore them. Do your own research.
Solid advice. Last one?
Don't believe in foolproof strategies, especially market timing. Bernard Baruch said, only liars can time the market. John Bogle agreed, nobody does it consistently. If something sounds too good to be true.
It probably is.
Absolutely. Think Bernie Madoff. His promised 10–12% returns year in, year out seems modest to some, but consistently achieving that in the market is impossible. That consistency itself should have been a massive red flag. You can't just rely on regulators. You need skepticism.
So really, understanding behavioral finance isn't about becoming a perfect predictor or finding some secret formula.
Not at all.
It's more about understanding ourselves, right? Recognizing our own built-in biases, the ways our brains can trick us.
Exact.
And then consciously trying to counteract them. Making more disciplined, less emotional decisions for our own financial future. Knowing the enemy.
And realizing the enemy is often us. It's about self-awareness.
So here's a final thought then. If behavioral finance shows us that even the pros, the arbitrageurs, don't always fix market irrationality, and that our own psychology is a huge hurdle, does that mean there are still predictable patterns left?
That's the provocative question, isn't it? If markets aren't perfectly efficient and psychology drives predictable mistakes, could a truly disciplined investor, one aware of these biases, potentially exploit them?
Find an edge, not through complex models, but through understanding human nature.
Perhaps. It certainly shifts the focus. Maybe the biggest edge isn't just analyzing companies, but analyzing and controlling yourself. Something to think about.
We genuinely love to hear your thoughts on this. Jump into the comments section and let us know what resonated. Which type of wealth are you focusing on?
Yeah, let us know.
And hey, if you found this discussion useful, maybe learned something new, definitely hit that subscribe button. We do these deep dives regularly, exploring valuable ideas.
We appreciate you tuning in.
Yeah, thanks for joining us.